All right, well, welcome back. We got another Knowledge Hub Plus. I think we've been calling these the Jamie and Eric show, or maybe it's the Eric and Jamie show. I don't know. But this is cool. This is timely. I mean, I don't know if we can mention the date that we're recording this, but it's like mid-March 2025.
Yeah.
I actually had a call, for what it's worth, in the end of February from a client that said, "Hey, I'm thinking about making some changes to my portfolio." And at the time, I was like, "Mike, we just hit a new high in the S&P like a week ago. Do you really want to do that?" Well, little did I know that this tariff talk would be kind of a deal. And so what Jamie had this great idea is that what we should do is an episode on managing retirement income during times of market volatility.
Yeah. I mean, because we're living in it, right? The best conversations are the ones you're living in right now. That's always the most fun. And I told you when you were like, well, why are you thinking of this? Well, I got asked this week too, right? By one of our clients was like, well, what do we do? Is this going to continue too? All those questions. And, what do you do for your income when everything's bouncing around? There's a lot of uncertainty. So, yeah, I think our goal today is to give you some views of that, maybe some things you haven't thought about to talk with clients, with too. I think, there are things that when you get caught in the daily grind of just people calling you and you're trying to calm them down, you're being reactive, maybe not proactive. So, are there things that can put you in a better spot too, maybe in the future?
I agree. I don't know if this is the best way to start this, but I wanted to get your opinion on this right off the bat. So again, like you said, this has been in the news. We're both on LinkedIn, Twitter, blah, blah, blah. I won't mention the person's name, but I saw an advisor who's kind of a thought leader, or whatever you want to call it, that maybe specializes more in the behavioral finance area. And his point was, during times like this, what the kind of gut reaction is to go, "Hey, client, we've been through this before. Show data, show the drawdown, show like what happens when the VIX hits whatever 25." And his approach was, what his kind of advice was like, "Hey, actually, instead you want to like tap into people, like how they're feeling about it, because essentially that's why they call in the first place." I kind of have mixed feelings on that, because there's clients that are going to fall into both categories. I'm curious what you think about that, if you have a gut reaction to either of those approaches.
Yeah, so it's an interesting conversation. I've actually approached it in my firms differently during two different time periods. So I don't know that I have a strong stance one way or another. But I'll give you the one, like back during COVID, what we really shifted to during 2020 was more towards that sentiment of like, we need to let people feel how they're feeling and not try to steer away from it too much and actually recognize the fact that, like, the markets went down briefly, but honestly recovered and basically, not technically straight up, but went on a pretty good tear since then and continued the kind of growth time period we've been in. So, like, what was the right decision? The right decision was to stay the course, right? Like, it wasn't to reallocate and readjust. Like, that was the wrong decision if you did it then, because you couldn't have timed either one of the bottom or the top then, right? Like, it's just nobody did. Um, so a little bit of that is like, I think that both are relevant. That I think the bigger part is you do want to let people be able to express how they're feeling and ask questions and listen. However, I do believe that the best course of action for most advisors is like, this is something we've seen before. Before we hopped on here, I told you like during when President Trump first went into office, we did have in between the election and his inauguration day like a ton of volatility, and it actually went up between those two periods, right? But there's still volatility, but it was up. Right now, we're kind of in a little bit of a, we're uncertain period, but you always are. I mean, I think that's the other thing is doing enough of these webinars and talks. Like, I don't know when I'm ever in a certain period of time. Like, they're always uncertain. And so I think a big part of our job as advisors and advice givers is to give our historical experiences to somebody. And that is truly what people are asking for when they're asking for advice. I actually just published an article in Forbes on that, which is like, what is really advice? Most people are not looking for the answer of what to do. There are some that are, right? Like, and those people tend to be seeking confirmation. So, like, they're actually not seeking true advice. They're seeking, Eric, I'm thinking about doing this. Should I do this? Yes. Okay, I'm going to do it. Even if you tell them no, they're probably still going to do it. um,
Yeah.
and then most of our clients, although some advisors' clients do fall into that category, most of our clients are delegators. And what they're really delegating is the fact that they don't have the experience in this particular area. So they are looking for somebody who has that historical knowledge and experience and relevant experience to help guide them in that decision making process, but not fully make the decision for them. Right, that's kind of the choice architect. Like, they still want to see that they have control, and that's why they're meeting with you. But you can frame it in a way that they're probably going to say yes to your solution. I knew a couple advisors that during periods of volatility, they would always show them like three, like a super conservative, kind of a middle road, and like just the kind of whatever they were on, like continue. And they were like, without any doubt, everybody, if you gave them those three options, pick the middle road, right? Like, so there's another with like, that's another way to approach it. It's like, you can just be like, hey, if you're feeling really stressed right now, here's three pathways, and just know that the middle one, it doesn't matter what you pick for the middle one. It's just you show a middle one.
Right,
It's
right.
like, and people are gonna go, oh, okay, we'll do the middle one then. So yeah, that's a little bit of a rambling of a couple different ideas there, but I understand the point that the person was making. I think our job is to keep people on track, not just get pulled in the direction that somebody wants to go. Um, I'd argue that that is brokerage and not advice. It's transactional, and you're listening to what they, just what they're directing you to do versus helping educate and advise somebody. I think is a different goal, honestly.
Yeah, I agree. I mean, one of the things that you just said really resonates with me. I know when COVID was kind of a thing, and actually, oddly, in March of 2020, and here we are in 2025. But
5 years later, half a decade.
yeah, yay! And like, a lot of clients were like, "Should I get out of the market?" Right? And I was gonna pull up a text, and maybe I'll reveal what this says later. Um, but just recently about this recent market downturn. But the point was in COVID, I think a lot of people were like, just like in any downturn, they were like, should I uh, get out or stay? And the messaging I thought was helpful was like, this doesn't have to be a binary decision. It's not like you're all out or all in. There's levels to it. So I thought it just made me think of that when you were mentioning that, like if there's like a high, medium, low, or whatever you want to think of it as, that like that is at least a way to demonstrate like, hey, look, it's not just all cash versus stay the course. There's layers to that.
Yeah. And I thought I've mentioned this topic to you before too, is I think that volatility, what it is really testing is like, it's the true market, like inopportunity test of, are you allocated correctly for your own personal feelings, right? Like, so if you felt like every risk tolerance questionnaire you said you should be aggressive, your advisor, and you invested aggressively and you felt good during all the upswings, but as soon as the market got choppy or there was a change in the administration, and all of a sudden all the fear in the world came in, to me, all that told you is, in the true test, was that you're over allocated to the market. And really, it's not that you should unwind from the market, but your allocation was off. And though all the testing measurements and everything out there said to do one thing, when we really put it to a test, like, we were wrong, right? Like, that's the reality, is that you were not as aggressive as you really thought. You were aggressive when everything was good, right? Like, you like playing offense when you're scoring a lot, but when the defense is really good and you can't move the ball, all of a sudden you're like, I don't really like playing offense today.
Right, right.
And that's a little bit of where we end up. I do think as people are right around that retirement age, right? We've talked about this in RICP, the first 5 years before, first 5 years after. I think some people get into their mind that like they're still okay with their previous allocation, but then all of a sudden when this hits, it's a risk to your, the way you're going to live your life. It's not just the market risk. It's, what does that mean for the longevity of my portfolio? And what does it mean for how I can spend and live my life? That's a different risk though than just, are you okay with market volatility? Like, I'm fine with market volatility today for myself. Why? Because I'm not using any of that money. I haven't checked my accounts this week. I haven't checked them last week. I don't know if they're up, down. I have no idea because I don't rely on that. And I'm not going to rely on it anytime soon. So, like, I'm okay. But if I was 3 years into retirement, what a prolonged downturn or high volatility means is my lifestyle has to change. My lifestyle is not impacted today by market volatility. So that's a big difference when you're in one of those moments where those then become lifestyle changes in addition just to up or down of your accounts.
Yeah, that's a huge importance. And, that made me think of too, in the last couple of weeks, I had a client send an email in, and the way that he was thinking about, like, the way he was quantifying the loss was not in a percent, and it wasn't even actually in a dollar amount. It was years of income. And
Yeah.
like, so the way, what the email was is, hey, Eric, I've, my account has now gone down by 1 year's worth of income.
Yeah.
Right, which is not like to what you just said. I haven't looked at my accounts either. I know that they're down, but I'm not thinking about it in terms of
No.
annual spending. It's just like, yeah, I'm sure it's X percent down, and for you and I, like, this is just part of the deal. And actually, it's a great buying opportunity. But for retirees, it's a different, like, you're relying on the money. And like, to your point, it seems like the big importance there is this going to impact my lifestyle, not just my standard of living.
Yeah, because those shift when you're right near retirement, right? You don't actually have to be retired when this shifts, but when that becomes a lifestyle bucket of money and an income bucket of money, it is fundamentally different in our minds than it is as a future savings bucket, right? Like that's where we are. It's why a lot of the techniques around bucketing it's a framing in your mind to turn that growth bucket into a future savings bucket, not an income bucket, right? It's still fungible. It's one giant pool of money, but that's the benefit of saying, hey, this third bucket in a bucketing approach is out here for the future. That's a savings bucket. I don't have to get as stressed about that. But when it's all mixed together, it's an income and a lifestyle bucket, which now that's scary, right? Like, do I have to get rid of my car? Like, can I not go out to eat this weekend? I had plans with friends. Oh, I wanted to go to, Nova Scotia and see the Northern Lights this fall. Should I push that off for a year? Right? Like those are then all the decisions that somebody has to make. We make them while working, but they're usually like a little bit different. It's like, if you have a bonus, you're kind of like waiting to see what happens with your bonus before you like buy a vacation or like get a new air conditioner or something like that, right? But it's different. But we still make those like spending decisions throughout the course of the year. But when it becomes income planning, the volatility has a lot more to do with it than anything else.
Yeah, absolutely. Here's something I want to get your reaction to, because this comes up time and time again. It seems like it's been part of the retirement income conversation a lot in the last couple of years, which is around, and I think we maybe have talked about it before, but it's, so, we have the different income strategies, which we could maybe walk through just to reiterate, kind of reiterate them. But one of them is around this framing issue around probability of success. And I don't know if that just, if you want to riff on that, but because I feel like what's going to happen is some advisors that use sort of traditional retirement income planning, or not financial planning software, if they're doing a review with somebody now versus, say, earlier in the year when the market was up, it's going to change something. And I'm just going to stop
Yeah.
there and let you run with that.
Yeah, so just go riff on it for a bit. Yeah, it's funny as like I've figured out throughout my career now. I get like topic areas that I have in. You kind of like develop over time views on stuff, and this is one that literally up until like what is it 3 years ago or 3 years ago, I really had no view on. Like I came into the industry like everybody else. We saw these probability of success models. They made sense academically. They make sense. You're like, these are good. Let's use them. Let's run analysis on them. Let's start talking to clients. All the software has them. You're like, good. And then all of a sudden, like two things really happened. One, I've mentioned this before, but I had a conversation with the spouse of a male client, so the female client, after the meeting said that chart's one of the worst charts I've ever seen in my life, right? Because it was showing all the little squiggle lines on the probabilities of how much money they would have. The one at the top end, which is like 5.7 million, down to like running out of money at year 20. And all she took away from that was basically every scenario in the world is possible. Academics were like, well, we're going to run 3,000 scenarios and test everything. But all that she got out of that was there are literally 3,000 scenarios that my retirement could go. which is not what you're trying to get somebody to. Like that's actually, I totally understood it. I was like, yeah, that's a terrible message that your retirement portfolio could end up in 3,000 different places, including like running out of money and ending up with like $5.5 million. Like
Right.
we should be able to do a little bit better than
Right.
that,
You
right?
nailed that. Yeah. Yeah.
And then eventually, like I started reading, and there was more and more research around guardrails, right? Which was that, like, hey, maybe we stop showing that binary, which you mentioned before, success or failure rates, because retirement's not about success or failure. People aren't going to succeed or fail; they're going to adapt. And people don't just drive off the cliff when it's 15 years out, just like the person who messaged you. It was, well, look, like if my income just got shortened by a year, it means I have to adjust somewhere. Investments, income, spending, lifestyle, like something's got to change, Eric, because I'm not just going to run out of income a year earlier. So I got to modify things. And I think that's the nice thing about the guardrail kind of conversation. And this is one I think volatility brings a great time for advisors to change their mindset and get proactive, because guardrail says, hey, look, like your account might drop, but it doesn't mean that you need to change your spending and lifestyle yet. Now, maybe it drops enough in a couple years where we do have to make adjustments. Let's change your spending for a couple years till it's back in line. Then you can go back to your spending. So the conversation gets away from success and failure, and it gets to this notion of, more like what's the likelihood you might need to adjust your spending, which is a completely different conversation than success or failure, or I ran out of a year of income. Well, you never run out of a year of income. You just adjust more. Like
Right.
two very different things.
Yep. I love that. Yeah. Because that's kind of how it started, right? It was like you would run a plan and you would say your probability of failure
Mhm.
is whatever.
Yeah.
And then people, like, especially the types of clients that we're working with, they haven't failed in their life. They're successful people, right?
Yeah.
So don't tell me about a failure. So then we're like, okay, well, let's change it to probability of success, which is just the same number, but the,
Yeah. Flip.
minus 100 or whatever, right? And
Yeah.
that kind of works. But then to your point, you have this wide range of possible outcomes, and it still doesn't really make sense to me. So probability of adjustment now is a better framework, which really tends to work more with, like you said, the guardrail type of system. I'm wondering, yeah, so maybe walk through, like, if someone's not familiar with, say, guardrails, maybe just walk through kind of what that is and what that means to have a probability of adjustment.
Yeah, I'll do the layman's version, but I'll shout out a couple people. Justin Fitzpatrick has a white paper and some stuff on Kitsy's website on this, and then really probably David Blanchett has some great work on this too. I'm going to use a little bit more of his stuff while I explain this, but there's different variations of guardrails. But the best way to think about guardrails is, right, just picture in your head, right, an upper line and a lower line, right, running horizontal on a piece of paper or computer screen, right? And that's your top spending and your bottom spending. And then your income is somewhere in between there. And the top one, what I like to say, is like the fun guardrail. That's like if you go bowling, you put the bumpers down. It's not for safety. It's just for fun. Like that's how kids have more fun. So that's your bumper. And if you hit that one, guess what happens? You have more fun. You can spend more money. So the other thing that upper guardrail tells you is, like, you're basically underspending, or your portfolio is doing better than we thought, or a variety of other things are occurring, but you're in a better place than we thought. And actually, you could spend a lot more and still have sustainable income. So that's kind of the top one. Bottom guardrail, that's when we're driving on the highway and we see the guardrails. They're for safety, they're there to keep us alive. And what that is telling us is essentially, like, you should look at guardrails as annual, or anytime you run the plan, is what's your kind of present value funding status for all future costs. That's how most people run guardrails in a simply put manner, right? Like, what's that? Do you have enough income as a present value to meet all these future expenses? And if you fall below that, then you're not funded. So that means we should adjust our spending, because our assets, we're not adjusting there. We're just adjusting our spending. But now, by adjusting spending, it will last through the time period we want. But as long as we're kind of floating around in between those two guardrails, what it's telling us is the volatility actually doesn't matter. Yes, you lost 3%, but the 3% didn't matter from the perspective of changing your spending rate. So you can continue to spend. We only have to get worried or make an adjustment to our spending when we hit one of the two guardrails. And obviously, you never have to make a change if you hit the top one. That's just up to you. You might not have anything else you want to buy, so that's it. So that's really a guardrails approach, and it moves away from success or failure to really this when might you need to change your spending. And that can get you into conversation with clients up front about like if something bad happened, let's say the worst case scenario starts to occur, how much could you cut back on your spending? Oh, 20, 25%. Would you be happy and fine with that? Yeah, I'd be fine for 2, 3 years like that. Well, that's a much easier conversation to have then, right? You didn't lose a year of spending like the one individual thought. Instead, you cut spending by 20% for 3 years. That probably makes up a full year of spending on the back end, right? If you can save 60% for 3 years, most likely that's a full year. So you don't lose a year, you cut spending by 20% for 3 years. That's a very different conversation.
Yeah, I love that. And the cool thing about using that approach, and again, it's not that we're like trying to sell it, but it at least I feel like it's an improvement over just like straight up um withdrawal rate driven, just,
Yeah.
oh well, the market's down, so now we got to adjust the withdrawal rate. It's like, oh, like it's kind of goofy. Whereas this, at least you have these predefined triggers. They're dynamic, so as the market changes, it's adjusting with them. And yeah, and like just to piggyback on that is like, so like let's just say the person was doing, say that middle line was a 4% withdrawal rate, unless you could do this different ways, like probability of success driven. But let's just say that all of a sudden the market does well, it hits what the account value goes up to now where that represents, say, a 3% withdrawal rate, whatever that number is. So it's like, wait a minute, that is too low. The thing that's cool about all this is that once you have that kind of dialed in of the approach you're going to do, it's like what you were saying, you can now communicate to the client what the frequency, the potential frequency of having to do an adjustment. So you could go back and go, look, like, let's say we had another COVID or something like that. Did we
Yeah.
have to do an adjustment? Okay, yep. Well, great. Well, how often does that happen historically? Oh, well, it's once every X amount of years. Oh, okay. Right. And then so it's like the frequency and then the quantity, or like the size
Yeah.
of the adjustment, like you were saying, because it's not just like, it's again, like it's not that binary decision of like you skip a year. Like I've seen withdrawal rate research where it's like, well, what if you just skip the year? Well, that's not realistic. No one's going to just skip a year,
Yeah.
right? I mean, yeah,
Some
granted, you
people.
probably have Social Security, but yeah. So I feel like that's kind of the other advantage. You've already had this game plan of like, you know, when would it justify a cut, and then how much would it be, and then you could kind of use that back tested performance or whatever you want to call it to say this is how often that would have happened, and then if so, this is what the size of the adjustment would have been.
Yeah, and if you look at Dr. Blanchett's research said was a couple things that like one, if you use this adaptive based approach, which is really more what if he was talking about, but you hit that lower end funding level and you adjust on average, right? You actually end up with a higher average spending rate that doesn't run out of money and the portfolio lasts for longer than like say a static 4% type model. So that's pretty interesting, right? That if you are willing to adjust, and his had like prescriptive things in the research he did, but the short answer is if you're willing to adjust some of your spending during a down period where you might become underfunded, it will raise your total average spending and it will raise the longevity of your portfolio if you're willing to do those things. And to me, that's how people live our lives. So I think the helpful part from advisors is the fact if we can get ahead of this, what we are modeling and explaining to people is actually more in line with how they're thinking and feeling and are going to act anyway, which that doesn't cause us to have to overreact to some really like unrealistic projection because the binary and static models aren't how we live our lives. So when something goes wrong, we adjust against that model because that's not how we were ever going to live. I think this is more realistic to how we are actually going to go through retirement anyway.
Yeah, exactly. Like you said, it's modeling closer to reality. The other thing that stuck out to me is, I think, and again, I forget if it's Justin's or David's Blanchett's research, but one of them has something too about when they've kind of asked people about, um, so cool. So knowing that this is the way that this kind of works, which risk level do you feel comfortable with? And the interesting thing is when you frame it in terms of this probability of adjustment,
Yeah.
people are willing to accept larger
Right.
probabilities of adjustment as opposed to framing it into like, hey, if you want to go from a like a whatever, like a 80% probability of success to 90, that's like we still don't really understand what that means. But when you're dialing it back into like, well, this is a probability that you're gonna have to actually adjust your spending. Oh, okay, right. And then it's actually translating into people actually taking higher portfolio risk or actually like what you were saying, withdrawing more per year, which then ends up benefiting them.
Yeah. So I mean, look, it's about how you set expectations with somebody up front. And I think when you set expectations around adjustments versus failure, that's a really important thing, right? Like if you were talking to your employees or somebody at your job, you wouldn't go to them and say, like, hey, if you don't do this, like you're a failure. Right. Like, no, you say, hey, if you don't do this, we're going to have to double down and get you help or retrain you or do something else, right? It's not just you're a failure if you don't hit this metric. So you think about that expectation setting that we use in other parts of life. Rarely do we go to anybody and be like, if this doesn't happen, you failed, right? Like you don't do that. Like even if your kids are playing sports, you're not like, if you don't score on this play, like you're a failure, like you failed at life. Like, no, like it's learning if you adjust. You're gonna take something out of it and we'll do something different next time you go try to score. Like that's. So when you start putting those things in other terms, sometimes you realize how ridiculous the like success or failure metric is. It's just not how we live anything. Even startup businesses, like nobody lives on success or failure.
I have something I want to circle back to that I wrote down when you were talking before. We were talking about risk tolerance questionnaires. Kind of
Yeah.
one of the systematic issues is that we ask these questions and it's about like, how comfortable would you be and blah, 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 blah. Okay. And so we know, like, even with research, we know that that doesn't really, they tend not to be great predictors of subsequent investor behavior. If you were going to add some questions to a risk tolerance questionnaire, is there anything that you think would be a better predictor, or something that comes to mind of like, oh, this is maybe what we should be asking?
So this is not my strength area. So and I'm not even sure what's in all the questionnaires anymore. But I'll just like give people a couple points here, and hopefully we don't get a Riskalyze and Orion fighting again like they did in 2020. So if people who are really into the industry might remember that, but they took some shots at each other that year pretty publicly, and it's kind of fun to watch on the side. I got baited into something that time too. Like somebody called me and asked me questions, and I didn't even know that it had happened, and yeah, kind of like commented. All my stuff was nice. I actually work with both of them very well, so like those organizations. But yeah, I think one of the challenges from my perspective on risk tolerance questionnaires has really been this notion of like, is it really just a COA, which is the kind of cover ourselves aspect of things, and are we really learning something that is measurable and true to the client? I think there's still debate on that, and I don't think that risk tolerance questionnaires are useless. I think they have a compliance place. I think they have an allocation place, but I don't necessarily know that anyone's shown out that these are like predictive of future client behavior yet. So I think some of the stuff, I typically would rather know is like, how did somebody react during the last prolonged market downturn? Like, did they fire their advisor during 2020 and hire a new advisor? Did they sell out of their portfolio last time? You'd almost want to see how somebody's reacted when, things have actually shifted and moved out there in the market versus just say, hey, like, let's see what this list of questions are. There's been some really bad questions historically too that kind of just tested somebody's risk taking behavior outside of the financial world, and that's really not a super effective place to go. Whether somebody likes riding motorcycles or jumping off cliffs is not super relatable to whether or not they are a good investor and can hold the course during market times. It's just different behavior than that. So I think when you look at all those, my preference is to understand how they've reacted in the past to similar situations rather than kind of what a list of questions might say. But you can ask some of those questions in it, right? Like, it's how did you react before? But as you know, the framing of questions is super impactful. And I think this is where, kind of true behavioral research inside and outside of our profession probably draws some criticisms if you really get down to how effective a risk tolerance questionnaire will be. Because if you frame something as what will you do if the market loses 40%, like, that's very different. You'll get a different answer than what happens if your investment maintains 60% of its value. And people are like, hey, actually, that's pretty good. My investment held up. Although they are the exact same thing, just on the flip side of it.
Those are great points. I like that. There's so many different ways I think you could do it. I think the one that really sticks out to me is that asking them sort of empirically, or whatever the right word is, like, hey, what did you do, like, say in 2008 or 2020, right? And then the difference there is that we need to account for the fact that they could have been in a different phase of work or retirement, right? Like, in
Oh
during
yeah.
COVID, they could have still been working or maybe not. So you sort of have to account for that. But I like that, instead of asking just straight up, like, okay, on question number 3 here, uh, are you a 1, 2, 3, or a 5? Or at least this way you could ask, like, hey, just give me a rough idea. What, how have you done before? And it gives you some better evidence.
Well, I was going to say that's a generation with questionnaires in general, right? When somebody's like, uh, self-reported stuff is so hard, right? Because even the grades and scales we use in our own minds are different. And so if you ever look at like organizations where like leaders have to rate their people, like you'll get teams that are like the worst performing team in the company, but their leader always rates everybody high. So everybody is a 5 out of 5. And then you got a tough leader and they're the top performing one in the organization. Everybody's rated a 2.5 because that leader sets expectations that, like, yeah, like, we're number one, but my expectation is we're number one. So that's a 2.5, right? Like, so it's interesting on that stuff too. That, that doesn't always, no matter how well you craft questions, there's this bias that individuals have on, how to report something like meets expectations. Well, we have vastly different expectations around things. So, that could be a good and a bad thing.
I will add this. So this is, if someone wants to read a really interesting dissertation, they can Google Eric Ludwig, Psychology of Investor Behavior. And instead of reading the 200-page version, I'll give you the one sentence one. That what I was trying to do is actually I tested this kind of like during 2020, just to see, like, hey, which of these factors mattered the most in terms of someone changing their allocation. And we accounted for like more of like the personality trait type of thing. So we asked like the big 5 personality traits, if people are familiar with that. Anyways, what ended up being the most important factor was their optimism about the subsequent 12 months of market performance. And the people that were the most bearish about the market tended to also be the ones that were most likely to reduce their own allocation, as opposed to those that were most bullish about the market in the next 12 months, or were more likely to keep their portfolio. And maybe that's not like a profound like finding. It's like, yeah, cool. So what? The reason why I think that's important is that you, as the advisor listening to this, you have that ability to shape that opinion, right? So because the text that I got, I kind of hinted at before, was someone saying that he wanted to Trump proof his investments and he can't afford to lose like last time he did. That last time Trump was in office. The funny thing is if you look at the last time Trump was in office, I think the S&P was up 65%. But this person has it in their mind that whatever it was bad, right? So I feel like that's where the value of an advisor can be like, hey, look, I hear where you're coming from, but let's just kind of walk through this, and then you can actually shape those expectations, like to what you were kind of getting at.
Yeah, but the other thing is you have to remember there were volatile time periods. So depending on how somebody reacted during one of those volatility periods, like, they could have lost something during a period of time, or at least remember the pain of 2020's loss, right? Because markets tanked for a couple months in 2020, right? And so, like, vividly you remember that scary notion of like, look, things were going down, and companies were shutting down, layoffs were occurring, and that is a memory and a real experience that somebody had. And those negative ones, as you know, are more powerful than the positive ones, right? So that 40% that somebody might have saw their account pull down for a couple of months lasts a lot longer than the 13% up.
Right.
Yeah.
Yeah, exactly. One thing, Jamie, I know like in RICP, we talk about these different distribution methods, retirement income methods, and we've kind of talked primarily about the systematic withdrawal approach, which guardrails is a part of that family. There's also bucketing and also the time segmentation, or there's also the sort of the safety first
Yeah.
approach. Um, I'm wondering if you want to mention how those, because really, in my mind, the benefit or sort of why people use those is for times like this. So I don't know if you want to just kind of walk through like why is
Yeah.
that?
Yeah, I mean, I think those are useful to quickly go through, and I actually think that's an area of the retirement income literature that kind of needs a broader refresh, because we really took the approach, right, that there were three. I mean, at the time we did that. I do think there are more, although you can always argue, like, systematic withdrawal, does that include all of them? So, like, you know, but it really meant, and I really do think that's probably where the update needs to come from, is like there probably are more like seven or eight that are worthwhile being discussed, and they all have different values for different people. So what we usually say, that systematic withdrawal, we're talking about like a 4% distribution strategy, or total portfolio distribution strategy is probably the best way to look at that. Is you're actually looking at the totality of your investments and trying to figure out a sustainable distribution dollar amount from that allocation for whatever time period. The challenge with that one, right, is the fact that when we get the really bad market years early in retirement, or honestly really high inflation in early retirement years, like those can become a challenge point for that strategy. Also, the number of unknown years at the end of it become a challenge point too. So like there are challenging elements of managing that one. A bucketing strategy really is more, while there are true bucketing approaches, right? Harold Levinsky ran a true bucket approach for years and years, right? Which is cash and then investments. And like it was a simpler form originally. And really kind of, was the, whatever you want to call it, the OG or godfather of that strategy. He really wasn't the first person to use it, but kind of made it popularized, right? And one of the theories around that one was, although statistically holding a couple years of cash actually does not outperform other strategies, it does give people this mental like assurity that they're okay, they have money, and maybe keeps them right in that higher overall equity allocation over time, because they know that there's this safety net of cash on the front side. So if you just test it in a, kind of in a vacuum, like it's not the best retirement income strategy, but for an individual, it might be the best retirement income strategy. And, there was actually some research done by Walt Warheide, American College, years ago that kind of showed the same thing, that these cash buckets actually would allow people to hold a higher allocation to equities over time. So there's some benefit to that, although, right, like just mathematically, you're like, it's not a great strategy.
Yeah.
Yeah.
You just
Uh,
said something I've never thought about it this in this term before, which was, and I'm going to rephrase this incorrectly, but that a given strategy might not be the best based, like say mathematically, or say like from a modeling perspective, but it could be the best for an individual,
yeah.
right? Like, and based on like,
Yeah.
hey, when the blank hits the fan, how are you going to behave?
Oh,
And it's
yeah.
like, wait a minute, that's not accounted for in this mathematical thing. So I'll let you keep going, and then I have an example of one that I want to run through from a math perspective. But I just keep going down your story. I just thought that was really important what you just said.
Yeah, and then so we'll go to the third traditional one, that flooring or safety first approach, right? And that was, go figure out your fixed income expense, your fixed expenses, and then layer in kind of fixed income or secure assets next to those. and then you could take risk on the other assets. Those were kind of the original three. I honestly do feel that that adaptive based one that we talked about earlier is really a different version. Like I don't feel that an adaptive based like guardrails model should be listed under, right, like a systematic withdrawal approach model. I think they actually are fundamentally different. I also think, although I don't believe in most cases this is the right model, I do think the approach of living off the income or dividends, is an approach. Like it really is, right? The live off the income, um, live off the returns and don't spend any of the rest. Like it, it's probably the model that advisors try to talk other people out of, but it is truly a retirement income like strategy. I do think that an RMD based approach should also be listed out. We've kind of lumped that under systematic withdrawal historically, but I think that's a different approach because really the systematic 4, 3, 3.5, they're a little bit different. They don't adjust as much for your like live time through retirement, right? Which is really where an RMD approach has some, I guess, better elements of it because it really is adjusting more often than a systematic, true 4% distribution strategy is. So there's a lot of those, different strategies out there. And then probably if it was up to me too in the world, I would probably strike out an annuitization strategy out of even a pure flooring strategy because there's other people that just go say, I want to annuitize as much of my wealth as possible. But it's not about a floor, right? It's just about creating less variability in my outcome, right? Is like I know I'm going to have X amount to spend and I'm going to live off of that and I will make my lifestyle fit that income stream. And there are a lot of, I mean, there's actually, there's millions of Americans that take that approach. I think sometimes we ignore the fact that there are a lot of people that just prefer that, right? Like, okay, I can go buy $40,000 a year plus Social Security. So that's my lifestyle. So then it means whatever I need to do, downsize, eat, whatever, live off the grid, get rid of my cell phone, like I will adjust my life to that income stream versus trying to find an income stream to support my life.
Yeah, oh, that's very interesting. Yeah, it's like you said, people are adapting. It isn't just dealing with the situation and being like, oh no, I'm messed up. I like drove off the cliff. I think is what you said before. They're actually adapt to their lifestyle. I think one thing I wanted to just do is from a math perspective, this topic is just so important to me. I just want to make sure I walk through one example of it. If people use it, if they great, if not, if you hate it, that's okay too. But one thing that's really near and dear to me is because I started in the industry in the fall of 2007. So my first 18 months on the job were during the financial crisis of 08, 09. And I wasn't prepared for how to be an advisor during that time, right? Like I thought it was all about building optimal portfolios, and all of a sudden I'm like, wait a minute, this is people freaking out about their lifestyle, like a lot of the things that we've been talking about today.
Yeah.
And this is just purely mathematical, but I thought this is interesting. So we were talking about this before we recorded, and I had a minute to run this. This is just a quick Monte Carlo simulation I did. So the numbers were on a 30-year time frame. Just assume someone starts with $1 million and they have this like kind of normal 70-30 portfolio. So 70% stocks, 30% bonds. And they're starting with 40 grand for an initial withdrawal. And they're going to inflate that by 3% per year. We know, and this is the way that it worked out, they have a 90% success rate, whatever that means, right? To have it last 30 years. Okay, fine. And that's like that's like
Yeah.
kind of the common thing. What I just want to point out, because this is near and dear to me, is I saw this get played out, is that people, I had a client on, this was like March 6th of 2009, which happened to be the low in the market. And again, no one ever knows this until hindsight. But I remember her telling me, Eric, I just can't take it anymore. And she took a bunch of her stocks and went to cash. And then I got to follow her now throughout retirement for whatever that's been, 17 years or whatever that is, 50, whatever it is since then. And I can see the impact that that's had on her. Well, mathematically, again, if you go from $1 million down to 800 grand, but if you flip the portfolio to 30-70,
Yeah.
and take the same withdrawal, it reduces the probability of success down to only 60%.
Yeah.
So granted, we know that this isn't just the way it's going to work out, but it is interesting to me from a math perspective of the impact that has.
I just want to tell you, when I did that rough math in my head, I was almost identically correct. I said about a third, right? It was like out of it. So yeah, that's pretty impressive. I was like, yeah, I was driving in the car, we were talking through it, and I was like, I bet it's about a third.
Yeah.
Oh, 30%. I feel really redeemed right now in my mental mess.
You are the Jamie Carlo simulator in your head.
Yeah. Jamie Carlo is not quite as good as Monte Carlo. Yeah, like one of my friends, Dr. David Roney, used to say, "Well, like I won't use the word because Reddy's on here, but is the less than good Chat GPT is what he used to call me because I've got lots of useless facts and I can pull up stuff and I'm like close to being right, although like I make stuff up sometimes, just like Chat GPT."
You know what's funny is I was gonna say this earlier is that I feel like all I have to do is type in a prompt and then let you go. Like you were kind of mentioning so in my head, I'm like, oh, you are like the Jamie GPT.
Yeah,
Well, one thing I know we don't have a ton of time left, but we kind of started talking about this earlier. I wanted to just get your follow up on this. We were talking about the difference between risk tolerance and risk capacity.
yeah,
They're different, right? We measure them different ways. And maybe again, that's my prompt to you is if you
yeah.
want to just kind of run with that to talk about why that is maybe an important factor and how that shows up in a time like this.
Yeah, let me hit that, and then I'm going to go directly into another thing because we've used up most of the time, and I don't want to lose sight of what are some of the tactical things you could do right now
Yeah.
in this volatility time period. Yeah, as you mentioned, risk tolerance versus risk capacity. Risk tolerance is typically that questionnaire. Really, the way that I like to best explain it is like, how does somebody feel about risk, right? Like that is probably the best way to think about risk tolerance, right? How tolerant are you? How do you feel about risk? Versus risk capacity, how much risk can you truly take on? That is really more of a mathematical approach, right? Like how much can your portfolio take from risk, in whatever risk we are talking about. So we have spent this whole time, though, actually talking about risk in the sense of volatility, really. But there's a lot of other risks, right? Like you can reduce volatility, but increase the risk of running out of money early.
Mm.
You can reduce volatility, but increase the risk of declining real spending through the course of retirement. So, reframing the risk that we are talking about is also really important. One of my friends, I saw that he posted, I'm going to mess this up, but Larry Sprung's a good friend of mine, and Denise runs his social. So, really, in all fairness, the two of them posted this. But, they said, right, what like volatility is the price we pay to invest. And I was like, that's a good one, right? Like, if you want to be invested and get the gains of it, volatility is one of the things that comes along with that. Because of volatility, right? We search for a premium inside of this world. But we can't get that premium in all these other non-volatile spaces typically. It's not that there aren't pockets of things, but generally speaking, that is one of the things that gives us, right, this higher return premium over time. But I think reframing to clients, like, what are the other risks, right? Like, this isn't the only risk. So when we do these trade offs, to your point, what happened to the portfolio when we reduced volatility risk and went to cash is we reduced the likelihood that this money would last throughout a life. We reduced the likelihood that you could spend more throughout the course of your retirement. So while we traded off volatility, we kind of lost liquidity because now we can't really do much with any of this money, and we also lost some longevity to the portfolio. So volatility, just reducing that is not necessarily making us any better in life. So I think that's important. So when you look at these decisions today, though, I do think, where a client is, though, they could be in a better spot emotionally and mentally by de-risking a portfolio. My advice is not always stay the course. My advice sometimes is, look, you can take 30% and put it into a bond ladder today, or some other type of fixed income, and actually like keep your spending rate the same. Yes, you're not going to have as much upside, but you can keep your spending rate the same, and you don't have to wake up as concerned about the market every day. If that's the situation and client really likes that and you can keep them in the same spot, I think where fixed income rates are today, are they going to come down again in the future? Are they going to go up? Are they going to stay steady? We're not at zero. We're not at zero rates anymore. So it's a little easier to actually say, yeah, we could de-risk a little bit there. Same thing is now a good time to swap in some annuity income to a portfolio. Again, you'd rather sell at an all-time high, but like framework backwards is the fact that, like, we're still probably higher than any time period today outside of you know this year. Right, like in all true fairness, like we're probably at the height of last year right now. It's like, okay, so we're at like a 1 year all-time high, right? Like, or whatever, how you want to say it. Outside of the last year, we're at an all-time high. So it could still be a good time to de-risk the portfolio and build some longevity income into there. I think other things are, is it a good year? Just if they're feeling worried, what are some expenses you don't have to eliminate? But instead of, this is kind of what I said before, sometimes if you're like a business owner, you have to make that decision. Am I booking an expense in December, or am I booking it in April? Because cash flow matters there. So if I can push out an expense 6 months, 3 months, 4 months from this year to next year, should I do that? Or even the flip side, you should make that decision. Sometimes there's good expenses to book this year. Maybe we should give twice to charity this year, bunch it together, go higher up above the standard deduction and get an actual deduction for our charitable giving. And then all of a sudden we got back 6 grand in taxes this year, and that offsets our market depletion by giving an extra 10 grand. So like there are things like that's where the true value to me of advice and advisors comes into this income planning. So looking at expenses we could either bunch into this year or push off can be a really valuable way to add value back to that income plan.
I like that. Yeah. So it's using this as a planning opportunity, which is, again, in theory, what your job was to begin with, and not just running from it. And yeah, I agree. Somebody asked me on a webinar yesterday, is like, should we be worried about this? And I thought, if you want to provide value to your clients, like, granted, that's what most people are trying to do, that this is where it's your time to shine, right?
I've got one other one, and I'll ask you a question about this. It might lead us to, if we do another one of these episodes soon, this might be the topic, but kind of about what to sell when. I think that most of the historical and even most analysis is kind of done with a portfolio that moves together, right? Like when we talk about like historical and Monte Carlo, we're really talking about it as an asset class that's moving together. However, in reality, it's not what's happening at all, right? Like there are stocks that are up 20, 30% this year. The portfolio is not down across the board. Like, in fact, there's stuff that is reaching its all-time high today. So the interesting thing is that's not fully accounted for actually in a lot of research, right? Is the fact that like you can actually pick winners and losers throughout the course of a year and actually sell one and keep the other one that is technically down. um, but the funny part is like while that becomes an interesting conversation, what I've found a lot of times is like trying to convince somebody to sell the thing that is up is almost impossible, because they're like, wait, Jamie, you're trying to tell me that the only stock that's performing well, you want me to sell? And
Right.
it's like, well, yeah, but it's the same thing that's happened with crypto. When crypto had that big run up, there were people who probably would have liked to, reallocate. But at the same time, you were like, well, it's like Bitcoin reached its all time high. It's the best performing asset class I had last year. And you want me to sell it and like buy other stuff that hasn't done as well? Like that is a really hard thing if you have to have those conversations. Now, if you're running models and the reallocating inside, you don't really have those same conversations. But if you have to have those, like they're tough. So it's that's a whole interesting topic. So we're ending on a cliffhanger, and people can think about that.
Yeah, no, I'm with you. I mean, but even to that other client that I was talking about that sent me the how do I Trump proof my portfolio?
Yeah.
That is the first thing I did. Is I looked at his portfolio. I'm like, let's just punch through here and see how the individual holdings are doing, not just the portfolio, right? And then that's where it's like, well, wait a minute. You hold these three things because this generates your monthly income. Do you want to mess with that? And he's like, well, no, I guess not. I'm like, well, then you have these different bond holdings. They're actually have held up really well during this. Do you want to mess with that? No. Okay, now we got X% left in stocks. Do you really want to goof with that? Oh, I didn't realize it. It's like, yeah, remember, that's why we own each of these different things. Oh, yeah, duh. So big picture, it looks like this, but when you drill down, I think to your point, there is some benefit to why you would do that. Yeah. Well, that's cool. I don't know. Are we done for today?
I think everybody, that is it. We should probably give one shout out though. The Horizons event. If you weren't there for American College out in San Diego, fantastic, all retirement income planning. I don't know how many presentations and times you had to get up in front of people and talk, but a lot. You did a fantastic job. I got to witness it. And all the speakers out there, right? I mean, I saw Sophia Duffy speaking, and Michael Finca, and Kitses, and Wade, and Dr. Carolyn McClanahan, just like amazing speakers. So super excited. I know there's going to be another one next year for all the retirement income junkies and nerds out there. I'd say, pay attention and look out for that one coming out sometime soon too, right?
Yeah, yeah, I'm excited. I believe what I've heard is that 2026 it'll be in Florida.
Yeah.
So I hope that's okay to share, but that'll be
Yeah,
equally fun.
they told us there, right? So it's like, it's like a secret to 400 people. I don't know.
Yeah, right. That's awesome. Yeah, and by the way, Jamie was there. Awesome presentation, and yeah, it's really. I'll tell you this: the thing that I liked best about it was that the thing, like all the events kind of ended earlier in the day, so
Yeah.
people could go out, kind of hang out, enjoy the area, and I thought that was really cool.
Yeah, I like that everybody was in income planning. Like I thought, like I've gone to a lot of stuff over the years, and it was actually cool for me. It's really the only other one I really remember having a similar feel was Investment News ran that Retirement Income Summit for years, and that has similar feel. A lot of people that used to speak there was a different crowd because they actually had more like sponsored product stuff back there then, but this was a lot of the research, the academic world of it. I thought was super cool.
Yeah, yeah. Well, thanks for mentioning that. I think the thing that I'll mention that we always do with these is if you like this, send Jamie a message on LinkedIn. If you didn't like it, you can send it to me. But either way, we do like hearing the feedback. So yeah, hopefully we can keep the conversation going on LinkedIn or wherever else you might find Jamie on Twitter or
Yeah,
the NASDAQ. Who knows where you are?
it's okay. I will take the bad feedback from this one. So that's Volatility. You used to have to take the other ones. I'll take this one. So if you have complaints, send them to me this time.
All right, fair enough. All right. Well, thanks everybody for listening. Hope you have a great rest of your day.
Expand your opportunities at theamericancollege.edu.